Hey everyone, it's Bob with another FinOp Controller webcast. This week we're going to discuss reserve lines 2 and 3, customer bank loans, and stock loan. These items are related to your customer margin debits. All right, let's do a short recap on the credit categories for the reserve formula. You can see here, like I said before, we're going to be talking about lines 2 and 3. Money's borrowed using customer securities as collateral, borrowed from a bank. The other one is money's received from stock loan of the customer securities. So let's flip over to the next slide and let's discuss what we're going to be talking about today. And the first one is how much can the firm borrow using customer securities? How much of the customer securities can be used as collateral? What happens if you've got excess customer securities? What do you have to include in the reserve calc? Can you keep customer securities at the bank if you don't have a loan? And what is a death spiral and window dressing? Before we get started, here's a few disclaimers and notes. I think the largest one is that this presentation is for educational purposes only, and it's not legal advice. Again, I'm going to always direct you to the interpretations for financial and operational rules at FINRA's website. And really, this is just kind of a primer to give you an idea of how these rules work. The last one with the notes is one way to use this presentation is to review it versus your firm's calculation and compare the items. So let's talk about bank loans, which is really just outside financing for customer margin debits. Now, the firm can lend money to customers to purchase securities. And the amount borrowed by the customer is called a margin debit, which is really just a customer receivable. And the firm is going to charge the customer interest on the loan. If the firm doesn't have its own funds that it wants to lend the customer, then it can go out and get bank loans or use stock loans to handle these transactions. If you go out to the bank, you're going to have to pledge collateral to the bank for the loan before it lends you the money. And at the same time, the bank will charge you interest on its loan to the firm. So let's talk about some of the limits. The maximum amount the firm can borrow is the total amount lent to customers to purchase securities. In our business, that's known as the aggregate debits, aggregate margin debits. All right, what's the maximum amount of securities that can be used as collateral? And that's equal to 140% of the customer's margin debit. And if you do the inverse, that's approximately about 71% of the security's market value. Now, a bank, depending upon what the security is, sometimes will accept less collateral than the maximum amount. And those excess securities should be reduced to the firm's possession and control. So what does the reserve calc line look like? That's line 2, and you're going to include on the reserve calc the lesser of the following, and that's either the amount borrowed from the bank or the market value of the securities used to collateralize the loan. And essentially, this is going to have a zero impact on your reserve formula simply because the amount that's borrowed from the bank will offset the amount on the debit balance side with the customer receivables, at least up to the amount borrowed from the bank. Now, there's an item that you're going to have to subtract, and that's if you've ever gotten a bank loan for customer non-purpose loans. And that's only if a separate non-purpose loan, bank loan is maintained at the bank, you're able to subtract that out. If it's not, if it's commingled in with the regular customer bank loan proceeds, then you have to add all of the cash into the reserve calculation. So what's a non-purpose loan? And that's when a customer uses their securities as collateral for loans that don't involve the purchase of securities. So, for example, if a customer wanted to buy a boat or a car, wanted to pay for a wedding, if they have home renovations, any of these items, a customer can borrow from the broker-dealer, and it's going to be a non-purpose loan. The loans aren't covered under Reg T, so the broker-dealer is allowed to lend more on the market value of the securities than the usual 50%. All right, so the customer is going to pledge its securities as collateral. The loan's usually interest only with a floating rate. However, the customer can have a margin call if the market value of the securities drop. Now, be aware that on the reserve calc's debit side, non-purpose loan receivables are not included. So, a couple other things about bank loans. One of them is business continuity planning. And should the firm keep customer securities at the bank if it does not have an outstanding loan? Well, in case of an emergency, the firm might need a quick bank loan, and if there is no collateral being held at the bank might not go through with it. So you want to make sure, you want to talk with legal, make sure that your bank loan agreements indicate which securities are being used as loan collateral, and that the remaining amount held at the bank are free of any liens. Consider doing this as part of the firm's business continuity planning process. So let's talk about the death spiral and window dressing. And the first one is death spiral. And here, that's when a firm uses customer bank loans to pay for purchases when the customer has already sent in funds to purchase the securities. And say, for example, say the customer buys shares on a Thursday for settlement on Monday, that's T+2, and the firm receives the customer check on Friday. If the customer's cash will be deposited into the reserve account after the reserve calculation is done on Monday, so now the firm has to use its own funds to settle the securities purchase. Now, firms with insufficient capital or credit will use customer bank loans to pay for purchases, which will increase the reserve deposit until they pay down the bank loan. And usually what happens there is that they continue to borrow using customer bank loans, and the spiral begins. And eventually they're going to hit the maximum amount the firm can borrow using all the customer securities. So how do you get out of that? One way to do it is to petition the SEC staff for relief. They will agree to the relief. However, they're going to have to see the firm is recapitalized. Now, one thing you might be thinking about is, hey, we could use customer bank loans throughout the week and then replace them whenever the firm does a reserve calculation. This is what's called window dressing, and it's specifically forbidden by the rules. Also, any other device that's used to get around the reserve calc rules is forbidden. So be aware of that when you're talking with other people within the firm about ways to reduce the deposit amount. So let's take a moment and talk about stock loan, and that's lending the customer securities to other broker-dealers. Now, another broker-dealer might need to borrow securities if they have to make a delivery. And usually that will occur when the other broker-dealer's customers have shorted a security, or perhaps there's insufficient securities in the broker-dealer's own box and they have to make a delivery. So the stock loan can function as an alternative to using bank loans for financing, and the reason being is that in exchange for the borrowed stock, the other broker-dealer is going to put up cash. Now, they're going to charge you interest on that, on the cash that you're holding, but at the same time, depending upon how well your stock record department does, they will do their best to beat the interest rate charged by a bank. And in fact, when a stock is really in demand, the stock loan department can make a deal where it not only holds the cash, but it gets paid the interest. Now, the stock loaned is not considered hypothecated, and therefore the firm will receive at least the market value for all of the stock. In comparison, banks will only lend a percentage of the stock's market value, as we discussed before. So on reserve calc line 3 is stock loans, and so what's going to be included? And that'll be the total contract value of all the stock loans the firm has outstanding, less these allocations. Also, you're going to have to subtract off any stock loan deficits, which is the market value greater than the contract value, unless the firm is doing a daily mark-to-market, and falls within the rules. So if you have any questions, send me an email or contact me through LinkedIn. I'm Bob at rmmilburnconsulting.com. And that's our discussion this week on lines 2 and 3, reserve calculation, bank loans, and stock loans. Thanks.